This is Justin Pulitzer. This is my weekend review for Sunday, November 8th, 2015. This is actually, though, being shot on Friday, November 6th, 2015. I've been trying to get the videos out a little bit sooner. People seem to like that. So here we go. So I've been basically saying there are 6 keys to the market, and those being the VIX, the dollar, bonds, oil, China, and Biotech. So I'm going to go through those in a bit of a different order this week because at any given point, one of those might be the more important and dominant factor. And in this instance, I believe it is the dollar. So I was saying that there are a couple of ways to look at this, and keep this chart kind of in mind when we talk about Chipotle a little bit later. But you can see the dollar had been in a decline. I'm using the UUP here. This is the ETF. And it had really kind of settled into this lateral range here. So we were sort of, at least I was sort of thinking that this was either going to break in one direction or another, or it could just continue to seesaw and ping pong within this range. And I had drawn a trend line. We had had a violation here, making lower lows. And we were kind of testing the lower end of range. You can see we've had a breakdown of this lower end of range once before. We tested a little bit below and rejected, and then promptly rallied up. And I've been saying for a while that the real risk to the market is if the dollar starts really rallying, and that really did. I mean, look at how fast this came up to the top of the range, and now is actually above the range high. So we're going to have to see now if it's an instance like this where we look below and fail and reject back into range, and in this instance, are we going to look above and fail and then come back into range? So I believe early next week this is going to be a very big component to the market, and if we don't break down, this could easily come back up to the top of the range and cause some real problems for the stock market. Why is that the case? So a lot of people, again, I cannot believe we are here again, but we are. The Fed, I guess, these Fed governors and even now Chair Yellen just can't keep their big mouths shut. They have to talk up and try and make everyone believe there's going to be a rate hike. I believe that this is their attempt at moral suasion to try to prevent the market from having happen what went down in China, the blow-off type of scenario. I think their fear is that if the market really gets out of control and runs, that it could be susceptible to a crash and they'll have to do another round of QE. I've discussed in previous videos that given the data that we've been presented with, that if the Fed is true to their mandates that they've outlined, meaning their inflation targets and growth potentials, that they should not only not be raising interest rates, that they should probably be doing another round of quantitative easing, QE. So that is a very controversial point. I don't think it would be on the table at all this year, obviously. I don't even think it would be on the table until maybe the summer of 2016. My thesis has been that the Fed shouldn't be raising rates because they don't see themselves meeting their own 2% inflation target until 2018. So that's a ways off. We have basically a 2% growth economy. We've had very, very weak first quarters for the last 2 years. Things are starting to maybe get a little bit more iffy here. I do realize that I will acknowledge that the labor number today, the jobs number, was quote-unquote okay. I think the media really blew it out of proportion and made it out to be better than it was. I will remind you that they also were saying that the number last time around was good enough for rate hikes as well, and that was a miss, like a huge miss. So I honestly think that the number could have came out today, and if it was basically anything that was positive, the media would have gotten into this whipped-up frenzy with regard to rate hikes again. I heard Dudley, he's one of the Fed governors. He's actually the New York Fed governor. He seemed to be a little bit of the voice of reason here, and he was saying that, it's only one data point. So the Atlanta Fed had recently just lowered their GDP forecasts. I think that it was raised actually after the this week. I think it had been 1.9%. Now it's 2.3%. They've been playing around with that number, but it's really not very strong. And if there is some type of a global hit that comes out of Asia or the Middle East or what have you, that could put a real crimp on the prospects for global growth, as well as in the U.S. here. If we have like a weak holiday season, for example, or if jobs fall off, I think a lot of this number was, I shouldn't say I think, I know because it's in the number. A lot of this was temporary hiring. And again, the quality of the jobs are really not good. Waiters, waitresses, bartenders, service industry jobs, and then a lot of temporary hires seasonally for the holidays. So yes, there was a little bit of an uptick. I think it was 0.4%. That's like the most since 2009 in terms of wage growth, but it's really nothing to write home about. I mean, you're talking about really small stuff. This could even be, believe it or not, the Walmart effect, because they are raising minimum wages, so other companies are probably doing the same. So I wouldn't get so excited about this, this number being fantastic. And it really drives me nuts because I get, there's a very vocal, I guess, set of reporters, and more frustrating for me because I have to deal with them on I guess, an interacting basis on the stream, people who don't seem to understand what a rate hike would mean. So I'm going to go through that with you very quickly right now, and then we're going to get back into these charts. So if there is a rate hike, that would mean that the S&P 500, number one, the PE multiple needs to contract because bonds become a, I suppose, more viable alternative. Even if it's incrementally on the margin, the PE multiple will need to come back in. The foreign earnings of companies that do business overseas will be hurt by this strong dollar situation. The further this goes up, we've heard this in conference calls from multinationals, the Apples, the Nikes, the Facebooks, you name it. Anyone who does business overseas is going to have problems because their earnings when they repatriate the money are going to be worth less. That is a huge problem. The biggest one, there are a few other ones if you want to look through my tweets. I don't want to spend too much time on this. It is really important though, but I have spent so much time on this in the past, and I've done it in my periscopes that it gets a little bit redundant and monotonous for me to repeat, but it is very important. The most important, though, in my view, is that the Fed would be moving from a stance of accommodation to tightening, and they would be doing that in a period of slowing growth. I know that the real estate market, for example, in New York, which is a big leader, is starting to slow. The GDP, we know, is slow. The Fed recently, even with Yellen, said that they had just recently downgraded the jobs market. So maybe they know something that we don't, that could be coming down the line. I don't think that people understand that. They keep emphasizing, it's only a quarter of a point, it's not a big deal. It's a huge deal because it's a policy shift. The policy shift is what matters, not the amount of the raise. Once you can get that out of your head, you really understand the crux of the situation here. And the ECB and the Asian countries, so the European Bank and the Asian Bank, China and Japan, are basically doing their version of QE, and they're devaluing their currencies. If the Fed decides to hike interest rates, that is going to exacerbate this situation with the dollar tremendously. So it would be, to me, a very huge self-inflicted wound. It would obviously increase the amount of money, first and foremost, that we have to pay on debt service. You may hear on the TV, on TV that we have $19 trillion in debt. That is true, and the more you raise interest rates, the higher that service becomes, and the Fed rate hike would exacerbate this move in the dollar and make it even worse. And I know the Fed has mentioned that they are cognizant of that, so if the dollar keeps rallying, it may spook the Fed. Anyhow, that's the UUP, that's the dollar. Let's talk about the TLT for a sec. That's also a key thing here. I have a lot of lines drawn in here. Let me just get rid of this Fibonacci level since it's not really that relevant at the moment. But you can see that we were in a bit of a channel that I had been discussing, although we had been toward the lower end of it. And this was the day that the, I think the Fed minutes came out. I have to check. And we basically sold off from there, held kind of this lower part of the range, and have just been stumbling around. And those of you who have been watching for a while, back in 2009, I don't want to go back, I don't want to spend too much more time on this, but take my word for it, this was the crash peak of 123.15, and I've been saying that that's a key level to be over for still lower interest rates. And we have actually been having higher rates. We broke down here. You can see it was trying to stop, and then it broke. We are at the lower end of this range here. If this swing low gets broken, I think that this could fill up very quickly to the lower end of the range here, back down to the 114s. These 118 area has been very key for a while. And if we lose that area, you can see it's sort of the end of this volume distribution. Rates are going to go up. And one of the big problems with higher interest rates is that stocks are valued on what's known as a discounted cash flow model. And basically all you have to do is to understand this in terms of what you need to for this exercise is know that there is a numerator and a denominator. The denominator is the numbers on the bottom when you're doing division. And if you are dividing, let's say, the number 10 by the number 2, your end product of 5 will be a lot higher than if you higher than if you divide by, let's say, 4 or 5. That it becomes a big issue. So that is basically what you need to know, is that the discount rate, which is the risk-free rate, the bond rate, that is a component of that denominator. As that goes up, stock prices need to come down. Meaning as this goes down here, this is the price of bonds. Their yields go up, and that hurts stock prices. If this rallies, we will see, obviously, the PE multiple, the amount that people are willing to pay for earnings, go significantly higher. So we'll see how that plays out. I am very cautious here if we lose this swing low here of this in the 118s. It wouldn't shock me to see this thing do some type of a throwback. So don't get too excited if this does kind of hold here and then rally back. We need to see it get back into the channel. So that is my take on the bonds. They're kind of confirming the dollar. It's a bit of a problem. The VIX, which is the stock market, doesn't seem to be very concerned. It's very ho-hum. Although we could just be building a base here like we did here to spike maybe in the next week or two once the dollar, if and when the dollar really gets going. We are below the longer term trend line. We're still below this trend line. So that is positive for the bulls. The only issue that I have, we are kind of mid-range here in the 14s and 15s, and that's roughly where I thought we would bottom out. We did get a little lower than that into the 12s. But do keep in mind that anything below this 1153 has been unsustainable, and we are kind of going to get toward the lower end of the range if we do come down a little bit further. So VIX really not showing its hand here very much, other than showing that the market doesn't seem to be that concerned about the situation. The oil, which is very important, that's being used by traders, or rightly or wrongly, I believe it's correctly, is being used as a proxy for global growth. We're kind of just in this consolidation flag range. We kind of had a little bit of a look below fail, came up. I don't know, but maybe this is a little bit of a kind of a head and shoulders. Maybe it wants to break and retest the lows. I've been operating under the assumption, and I said there are kind of two types of people in this world. Those that like Elvis and those that like the Beatles, and you could like them both, but you can't like them both equally. Or people who are under the impression that oil has bottomed or that it has not. I've been under the impression, the assumption, that this took out enough of it. This level is unsustainable. 37 was the breakout. I don't want to go back after the 09 lows. We got very close, and I've been thinking that we're kind of building a base and that the risk is probably to the upside given the Middle East tensions And maybe if the economy is actually getting a little bit better. I know that companies have been shutting down some of their production. One I don't mention here very often is copper futures. And these are in a very precarious situation. Maybe you've heard on TV that's being referred to as Dr. Copper. There's a range low here from going back to that time as well. And we are on 1, 2, 3. Or we'll just count this as 1. So 1, 2, and 3 touches. This may get a bounce, but if this breaks here, I'm going to really start thinking we have major recession potential. So do keep an eye on this. This chart and the dollar is what Janet Yellen should stay up at night worrying about. This is very, very scary. This shows that global growth, particularly China, is majorly slowing, and we know the Fed is concerned about those risks. They've tried to walk that back in their recent statements because they took a lot of heat that they're worrying too much about foreign countries and their woes, and they should worry more about the U.S. This will directly affect us. If this snaps, be very, very cautious. I'll be thinking recession. The FXI, which is China, this I had said is sort of in a channel. I thought we would come back up to this area, the 40.64. We got pretty close. It's now kind of just listing and kind of chopping sideways, pulling back, more so by time than by price. You can see we're now middle channel. It could have a little bit of a move lower. It wouldn't surprise me. This market has kind of rallied up a lot. It is just cooling off a bit. This was really basically where the major breakdown took place, so a little back off here is actually healthy. You just don't really want to see this fall apart. To me, it doesn't really matter if China rallies. It just cannot be in crash mode. If it's in crash mode, it gets everyone freaked the F out. So that's really what we need to keep in mind. Anything over the 37.66-ish area, that was these highs. You kind of look above here, failed. Here, finally went. If it checks back to here, okay. If it rallies, if it starts dipping below the 50 MA and there, I'm going to get a little bit more cautious and think the channel low. Oddly, I had been talking about BABA. This has rallied pretty amazingly off the lows. I cannot believe this stock was 57 and then was 80, 86 here. This is I mean, this is like a nosebleed type of move. It took out this downtrend. It took out this downtrend. This in gap fashion. This is almost like a professional gap here. And it just is run. Today, it had some weakness, probably some profit taking on Friday, and also the fact that you had this doji, but what more did this was news. There's a famous short seller. His name is Jim Chanos. He was the guy who kind of uncovered Enron. That's how he got his kind of earned his stripes. He's been a really rather spotty trader, in my opinion. He's had a lot of he's had a lot of success in the past, and I guess that kind of keeps him relevant, particularly with Enron. It's sort of like the Paulson people, he kind of came up with the shorting real estate, and I guess he's been, he was crowned God after that. They've all had fairly spotty performance, I believe, after their kind of big, game set, their home run World Series type of plays. But he had some pretty good luck this week with Solar City. I wasn't really planning on discussing that, but I'll do it briefly. Maybe after. Maybe I'll do it now. So anyway, let's get the point here with BABA. We'll wrap up with that. This band here is sort of the maximum amount I'm willing to see it pull back to before I say that the kind of uptrend is over. You can see I drew in this steep uptrend. These were reference lows here. You can see this was a look below and fail. Here was again a look below and fail, and then after here, this was a look below and go. So you need to really hold 82, 81, and you need to hold 77, 77. Funny, I know the Chinese like 8s. Anything with an 8, but here I guess they didn't like the 7, right? The 7 was no good. They needed an 8. Anyhow, that's neither here nor there. Just keep an eye on this area. If you start losing this trend line, and if you start really closing into this or below this this band it gets a little bit more iffy. It would be healthy if there was a pullback. Look at this. The gap fill is roughly about 50% of the move. It wouldn't shock me to see this do that at some point. I think, though, BABA has kind of turned the page. I'd wait at this point. I'd probably wait and see what happens after 11/11. That's their big singles day. That was the absolute peak of the stock last year, and we all know what happened. I'll show you that very quickly. Anyhow, this was, look here, this was this year was 11. These days here, this was 11/11, and within the next couple of days, this was the top of the market for BABA, and look what happened ever since. So it wouldn't surprise me if it kept on rallying for a few days. Maybe it wants to get back up to 94. Maybe it even wants to fill the gap to 98. But I would be really careful here. Chasing the trade location is obviously not good. The stock has run a ginormous amount. You're into a lot of resistance. Look at this resistance band here. So they're probably a lot. This is sort of where the dead bodies were with all the people who kind of tried playing by the dip here and are wrong. They bought it here, they bought it here, they bought it over here, and then they were probably in hope and pray mode. And now that they're getting their money back, they're probably, you can see here on the earnings gap, it was met with a selling immediately. This was probably people who had been long for a while, and they took this gap fill as a sale. And now it kind of is just still rallying a bit, but I would be a little bit cautious. I always say you can use big emotion day bars. So let's use the Chanos bar. Anything below 80.77, we're suspicious. Anything above 86.35, it would be a 2-day high. Anything over here would be a pretty big. I think could get a squeeze going and be a long. I mentioned Chanos. Let me talk about Solar City quickly. Look at this consolidation in the 45s. Lost it here, and now it is like at almost an all-time low. There was a reference low down here, and I actually tried buying this. I sold. I don't remember if I did share. I think I just did. I shorted puts. No, I didn't do shares. Sorry, I just did puts. I saw these tweezers, and I thought that there would be a rally. Boom! The next day there was. Then it subsequently had tweezers on the top, and then sold off. And then today I took this off for a scratch. I think I made like $4 on the trade, literally $4. So I just didn't like this range. If either one of these tweezers, the bottoming tweezers or the topping tweezers, are taken out like to the upside, I'll play long. If these are taken out to the downside, I'm going to play it short again. And we'll play it short. I think it can go lower. So that's Solar City. BIDU is another Chinese stock, just to get back on that China kick. This is getting really close to a gap fill and also to where some dead bodies are in a distribution. I will say this, I was bullish here. I said I thought we could come up and see the channel top. It did more than that. It broke out here, and it's kind of just consolidating a bit. The price action is bullish, but you have to ask yourself if you have good trade location. In the flash crash, the stock got down to $100. If you X this out, I'm willing to X this out. The low here was $130. The stock is up over $70 in a straight line. Do you have good trade location? That is always, to me, what's important. Are you near where there was a breakdown here? Was there a gap fill? You're late to the party. If anything, I would be looking for this to make a last kind of push to go completely vertical and to get short the thing, or at least sell some out-of-the-money calls for some type of a rollback. So that is the BIDU. IBB. This is a very, very key ETF. It is being used, I believe, it's a proxy for Biotech. Let me get rid of some of these lines. It's distracting. And you've had basically a head and shoulders top here. It broke down. You had a check back or an echo or whatever, technicians like to call this stuff. And it failed miserably. We did come back down and hold these lows. This was consolidating, and I said that this was looking a little bit bear flaggish, but I did think we could retest. And now we're here again and now failed. So, the downtrend line is really held pretty well. You're back below a secondary trend line. I would say that the 50-day moving average now is really key. I think what's really driven the weakness here is this this Valiant. I'm going to discuss that in just a moment, but let's wrap it up with this. I had drawn in here. I guess I need to redraw this. Some of these I didn't update before the video because I'm doing this like kind of close to after the market closed. So was it 341.25? So you can see, I think that the breakout was roughly somewhere between the 50 and the 61.8. There's also a gap fill down here at 306. So if this wants to pull down into here, I think you could play this with put ratios. I also wouldn't mind, I'm not so sure if the bottom is in. It really could, if it fails, see the middle of the range again. So I'll say put ratios. If we can really take out what you really need to start seeing with stocks, and I get a lot of questions, and everyone's always looking for the bottom, and is this the bottom? Is this the place? That is really rookie amateurish type of play. The truth is that you really want to buy something when it's in an uptrend. You see, you want to buy the dips when it's in an uptrend. You don't really want to buy the dips when something's in a downtrend because you can get slam-a-rooskied like this. So I would ideally here would like to see this pull back and then come back up and make a higher high here and not only break the downtrend, but break the last swing high. I like to see when stocks start making higher lows and higher highs. Then I'm comfortable. I know that I kind of have the wind at my back and I'm trading along the line of least resistance. What is the line of least resistance here? The line of least resistance is down. That is not where you want to be playing long. You want to be shorting rips rather than buying dips when you're in an uptrend. So when you're in a downtrend, you short the rip, you don't buy the dip. When you're in an uptrend, you want to buy the dip as opposed to short the rip. Very simple. Trade along the line of least resistance because the news tends to fall along the line of least resistance. I'm going to show you something that is an absolute disgusting thing. This is this Valiant. We know Bill Ackman is in this. There's a lot of other hedge funds that are in this. I don't really want to get into my opinions about those hedge funds or those traders, but I will tell you this much. They are in a world of pain. This was a head and shoulders top, and then this just got destroyed on that Citron research. So there's a couple of ways to look at this. This could be considered leg 1. This could be considered leg 2, and then there could be a final leg 3. You could also say this was leg 1, this is leg 2, and then this is the final leg 3. I'm more inclined to think that this is leg 1, this is leg 2, and maybe there's another leg even still lower. So you broke multiple trend lines. This was a secondary trend line. This was really the absolute primary trend line here. I'm going to make it even bolded. I have it bolded 2. I'm going to bold it 3. And look where this stopped. You stopped here. You bounced. You stopped again. Very minor bounce. And then took it out and closed weak. Below the trend line, below this low, I really wouldn't want to be long this stock as long as it's below 88.5. If you can get back up, maybe there's a bit of a bounce. But, there's so much news in this. It's so fluid. Again, the line of least resistance, I'd be looking to maybe short rallies over by the dips. This is career kind of ending stuff. I'm sure this is going to blow up some hedge funds. It could cause a really big liquidation in areas that people don't even realize. 100% retracement of this would be roughly about $42, and I believe that the Citron research was looking for $50. So maybe there is like a bit of a final leg lower. I said on the stream, I think when Ackman is out, like if he gets so brutalized that he has to kind of capitulate and throw in the towel, that will be in itself a tradable bottom. So that's my theory on that. If you hear he's out and there's some kind of last flush, it's probably a long for a right or right out. So that is the Valiant. So that covers my keys to the market. Let's get into some indexes. SPY. So we had this big consolidation area. We know we had the breakdown. We had the look in, the failure, a check back to the higher low, where I was maybe the only person bullish at that time. I've been using this low as the Fibonacci kind of anchor. anyhow, I know that there's a lot of levels and lines in here. Just stay with me. It's a little less confusing than you might think. This was consolidating in a a bear flag pattern. It resolved to the upside. There was reference lows here from the range breakdown. You could see, look, when we broke these levels, we had a cascade. We got up to there, backed off a bit. A lot of people thought this was going to be the top of the move. I wasn't as convinced. We held the 201.90 basically, this area, and then wham, I believe we had I think this was the Fed minutes maybe. And we stopped here. Then there was a gap over the downtrend line. This had to catch a lot of people short. I don't think they all had capitulated this day. And we held for a couple of days. I know that there was a lot of people who have been trying to short these kinds of like smaller pullbacks, and they got jammed. This was the Fed day. Now, anyone who follows me for a while knows that when there is a big emotion day like a bar like this, or in particular, like this was on Fed minutes, which almost became a full Fed day in and into itself. But this is a real Fed day. And I've often said that inside the Fed day range is a no touch. It's a short below or a long above. So we got up high, we got up to a reference high. This is all these levels that I've had drawn in for a long time are still acting well, so I keep them on the chart. We had a little bit of consolidation here. A lot of people again thought it was over, and wham, they got their face smashed in. It came up again, and then we've just had a little bit of pullback. So today we had I had been saying that these 2-day lows were going to be key, and anything below these, because you had basically equal lows at a top, the anything below there would be a short. Here you had a look below, fail, close back above, and again today you had a look below into the Fed range, and it rejected and closed higher, and it closed over these lows. You didn't close into or above the body of the range, so it was still a negative day, but it was basically nothing. So this type of consolidation still to me looks like this, or looks like this, or looks like this. It's very possible we're really close to the old highs that we do retest. We are overbought stochastically. We've come up huge here. But if you look at the selling in the market, the breath has not been trend day bad breath. And even with these quote-unquote hawkish Fed comments and hawkish minutes and the hawkish whatever, we've had bottoming tail hammers. That said, if we start losing these lows, the market is due for a pullback. It's very possible we correct to the lower end of the channel. That is the kind of breakout level from here and one gap fill. I believe the expected move this week is it's a little under $3. If it's down, it'll probably amp up a bit because the IV will get jacked. So we closed here roughly around 210.04. Really not a surprise that we pinned 210. That was a huge strike. We really need to hold that area. So if we rally, that takes us up to the old highs up here around 213. And if we fail, that roughly takes us down to about 207, which is sort of like the mid-range here. Potentially, I think it would probably be more of a down move. So it could be down to that gap fill area. So let's see what happens. Let's use this Fed range as the key. As long as we're above the high, I think it's okay to play longs. If you're in the middle, it's sort of iffy. And then below is GTFO and play short. One of the tells today for me was a lot of relative strength in the IWM. Why did that happen? Why was the market bearish or feeling bearish, but IWM with relative strength actually closing above these highs today? The answer to that is because of the strong dollar. This has been plagued by Biotech recently. That's been why there's a lot of relative weakness here, but you can see it's almost like forming a sort of inverse head and shoulders. This is the head, the left shoulder, the right shoulder, now kind of trying to break out. And more closely, look where we have held. 117.37. That is a really key level. And look, we have basically a low here rejected, a slightly higher low, and then an engulfing bar that took out the entire range here of the last 3 days. That is really kind of bullish. So why did that happen? Because the IWM is a lot of domestic stocks. They're not as exposed to the strong dollar. People were rotating money out of those big cap companies, that the Exxons and the companies that need, well, Exxon also, we'll talk about that one in a second. But taking money out of companies that have foreign earnings and putting them into companies with domestic earnings that don't have dollar exposure. That is why IWM was strong. Qs also, look at this. I mean, this isn't really a bear market of just yet. It's above the old all-time high. We made brand new highs in the Qs this week. Yeah, it's a little bit, kind of muddling, but we still closed above the old all-time high, even today on Friday. Yeah, you had a little bit of a trend violation here. Let me see if we closed below that little smidgen of trend. Basically right on it. But, this isn't really, it's very possible we have a big gap down on Monday and it engulfs all of this and it gets really bearish, maybe do a gap fill to the 109s, but as of right now, it's been, fairly strong. We're still coming from, albeit a little bit, but it is new highs. So why has that been happening? There's been a lot of strength in a lot of the momentum stocks. Qs are mostly Apple and Google and like the Amazon types. Apple has been acting actually more bullishly than I expected. They reported earnings. They were originally up, then they were down a bit. I thought that this was going to go negative because if you can't go higher on good earnings, and they had fantastic numbers, you'd go down. But I quickly corrected the ship on that, and I thought we would go higher. Anything above 119.75 to me is bullish. We got above there, kind of looked, chopped around a little. We're back up, and I think this was just a bit of a victim of some pinning. Also, we're at the top of like a little bit of a channel and into a volume distribution. You could see there was a bit of a breakdown here. So I think there are just some people who kind of got caught in this Apple melee the last time, and they're probably just booking some profits. But anything above the, let's just call it 119 to 120, that area, actually, let's call it this high here, 119.30. That was the earnings gap high of day. If you're above that area, it to me is still bullish. Below it gets a little bit more iffy. Amazon has been a monster. This thing just did the monster mash. Like, it's been doing it like for a while. Bottomed out. We all know it's been pretty bullish. The last earnings was a bit of this was an exhaustion gap, by the way. You can see ran up the exhaustion gap, a couple of days sideways, filled the gap, and then some, back down to the range, and then it's just been off to the races. However, if you measure a Fibonacci extension, I believe it was from this range I measured it, you are getting up to the 1.618 Fibonacci extension. This didn't back off that much quickly, but you had the gap here, similar to here, and once you got over the high, it was an off to the races situation. This is starting to become a little bit J-curve like, hockey stick. When you have a steady grind higher, that's healthy. The end move is when most of the big, this is moving in leaps. This is all the shorts capitulating. Nothing ever got rosier. It's possible that there's like a last push higher, but you are getting vertical. I would be looking to book profits if you've been fortunate enough to be in this. There'll be a period of time when Amazon pulls back, I assure you. Amazon, let's do Google. I'm going a little bit out of the order that I drew in. So I drew a channel here for Google. This is an artificial high channel, but the low is for sure. But I use this as a potential. So Google might rally a little bit more. It may have a little bit of, this sort of looks very Amazon-like, right? It had the gap, sold off, people took profits because they had all played long, and then it just kept on rallying. So anything above, the high of days, like for example, I just want to go back to Amazon for a sec. If there's a pullback to 619.45, it's probably a good buy for a right or right out day trade. I don't know if it'll hold longer, but that to me would work out well for like a little bit of a bounce, even intraday. The same thing with Google. Maybe it wants to, well, this isn't as far, so I wouldn't play it with this. The Amazon one is far enough that there'll be some price memory, but this is looking bullish. I mean, as long as you're above 752.05, you can stay long, in my opinion. Anything below there starts to get a little bit more iffy. My favorite stock of all time, no, Facebook. We did something quite spectacularly. We got over 100. We even got 110. My target up here, I had talked about 109.28. We got a little bit above there, and now it's selling off a bit. There is a regression line that I have drawn in for a long time now, since sort of Facebook was grown up off this gap. And you can see it was a trend line for a very long time, and moves on the bottoms, the wrong side of it, have not been sustainable, as have moves on the top side of it get a little unsustainable. So you can see it was resistance here, it got through here, but wound up being a little bit of more resistance. Here we got up to it, and now we are on the wrong side of it. This is now expensive. I do think longer term, like in the next year or two, maybe 3 or whatever, that this stock could double and be up ginormous from here. The earnings were fantastic. However, it was chased. Look at this. Look at it. It ran up again on the Google earnings. It ran into their earnings and then gapped on their earnings. So people were taking profits. There were probably like a lot of weekly call people. A lot of chasers got paid in this, and now it's just correcting. I do believe that it could maybe fill the gap. Anything to me below 105s, you got to kind of GTFO. Anything above there, I think it's okay to kind of stay long, although I did say that it was a good idea to take profits and hedge and you maybe buy puts or put spreads or sell calls. That was very prescient here. I know a lot of people heeded my advice. I think a few didn't, and they were kind of sorry about it today. This might just chop and go sideways for a little while, work off some of the excess, but I do like put ratios. I do think at some point this 99.24 breakout area could be retested. It would be great for me, in my opinion, if this did it in a straight line. Like if it came down completely and did it, I think that would get out a lot of the sellers, over a few days, and it could recharge for a reference move. So that is Facebook. Let me go to Netflix. This to me has been a little bit frustrating in the sense that it sort of either should go or it should not. It's kind of just being a bit of a lazy Susan here. I drew in a channel. This had a head and shoulders top. It had a breakdown. It turned out to be a bit of a false breakdown because we are above the neckline. We haven't taken out the right shoulder though. So it is still a little bit iffy. It had been in the downtrend. It has now officially broken the downtrend. It's consolidating under the 115. I think if you can get above this high, this 115.83, that this will want to fill up and get up back to the old high and retest. It's weird that it kind of was in an up channel and then it broke and it just sort of leisurely. I mean, it's up a lot of days in a row. It's good that it's consolidating. It wouldn't even be bad if it kind of came back down and retested this channel low. But I think that this is starting to look a little bit more bullish if the market stays, I guess, firm. This is really a range it's in here between 93 and 115s. If we can take the 115s here, we'll go higher. If not, it'll probably be a move back into the middle of the range, maybe 108 or 109 or what have you. That's my take on the Netflix. Tesla was bullish. I had talked in my last weekend video that if we were down into this, like a bit of a shake and bake, that it would be a long for earnings, and it was. It came up here. We're just consolidating for a few days over the 50-day MA. I don't know if I would consider this a secure high, although it is sort of a bit of a topping tail bookended by two lower highs. So if there's a gap down, it could get a lot of continuation. Like if you take out these 2-day lows, I think you can play short. If you get up above these highs, though, I think that this is going to continue to squeeze and maybe squeeze a lot, maybe to the downtrend line, believe it or not. I know that that might seem crazy. People hate this stock or whatever, but it is more possible than you might think. Price line. Are you going to come up for me? I don't know what's going on. Did the system freeze? Yep, we're a little bit frozen. I'm sorry, but here we go. So price line is in really what I consider a big channel. I think I was one of the first people to discover this, but I did. So yeah, look at this. It's in this just big channel here, and now we are trading on the outside of it. It came back into the channel. Ran super duper hard up here. So honestly, the ideal situation for me here would be if this had like some kind of like crazy gap up. It would be really exhausted, and I think that there could be a nice short. They're reporting here on the 9th, so I think it's pre-market. Let me see this. Earnings conference call, Central Standard. 6:30 a.m. So yeah, it's early. So I don't know that we're going to have an opportunity to really trade this ahead of time. The best thing would have been if this would have had some kind of a shake and bake. If this was down bigger today on TripAdvisor, like if it came back down huge here to maybe like the 50 or something on some kind of crazy big move, then I would be more inclined to play long. But look at this. I mean, you've really run up. I mean, if you're not booking profits here, I think it's a little piggish. If this does have some kind of dramatic fall like it has had before, you know, we know the channel. We know what to do. We know where to play it. It could probably be played with put ratios or spreads or whatever as a move short, or just play it long on the lower end of the channel. A couple of earnings stocks. Let's just go through these quickly. We know Chipotle broke down because of the issue with the E. coli. I think they had some E. coli in some of their stores. Now, I said that there were two ways to look at this chart, this sort of like the dollar chart. There's a big channel, similarly to like Priceline, and there's also a lateral range. You can see here, I drew it here, but it's really with where the gap, it's really here. This being, I used these highs, this was sort of a little excess. You can see that it was having a hard time holding there, so anything above here I didn't really count. I counted down here. So we came down straight from the top in a straight line, and I think it was having a hard time getting through here with sort of the reference lows. However, this did break the channel, and you can see it tried to rally and we failed. We did close in this day's range. If we were to rally today and stop below here, I would say that was probably a short. This sort of didn't close. This is how I'm really thinking to play this. If this hammer breaks here, this is probably going to be a continuation short. We are getting a little bit close to a gap fill, although I don't know if it's going to be as relevant since we already bounced and it's already near this kind of came down here, and a 61.8. So if you lose this hammer on the downside, I think that this will be a cascade still lower. That's probably not what's going to happen. What will probably happen is you'll get either a move in, probably in a gap. You'll probably suck in a lot of longs again. I would say you probably can play this for some type of a bounce, maybe to the backside of the prior up channel at the very least. We'll see how that goes. So if there's a move, preferably it would be like regular trading hours. The ideal, scenario for this would be if there was some kind of gap down on Monday and it was a tweezer bottom and it like made another hammer here. That would be a screaming long and obviously a screaming short even more exponentially if those two lows got taken out. But that would be the ideal scenario, or you can just play it as a long over this high of day here. So anything above like 613.49 I think would be a good long. FireEye. Wow, what a ride, right? I had talked about 126 puts being high OI, and that would be a magnet. It was more than a magnet. It took this stock down huge. It actually was a gap below the old all-time low, and it was really weak. This was a bit of an outsized move, but I think because it had moved down so much already here, Today we found buyers. I think the CFO and the CEO, I saw the CEO on Cramer's show. He really sounded to me like a man in an industry captaining a stock that's topped. But, I guess they put their money where their mouth was. They both bought stock. So if you can take out these 2-day highs on Monday, you'll probably get some kind of a gap fill. I do believe that, you see I have this area demarcated off. That would be my first target, this 27.5. So I'm keeping my eye on FireEye. I think that this could potentially set up for some type of a bounce. If we do get over these 2 days highs, that would be a good day trade. If you do get below these 2-day lows, look out. It's going to still go lower. Anyhow, I think there's one more I want to cover. I should have covered this after CMG, which was SHAK. So SHAK, I actually had a sort of a bet for a burger with my buddy Brad on this. And up here, I had said I thought we were going to see 39 again. We got 41 here and into here, 41s. And I mean, technically he wins the bet because we didn't get 39, although I still have till the end of the month, so maybe there is time for this to come back down. But honestly, this isn't really a bet I really care to win because I had been playing long. I actually have a smidgen still on here, but a little bit cautious because of what happened today. But you had basically double bottoms. It was kind of close enough for government work for me. I saw these little hammers here. I sold puts, and the stock rallied. But we are right back up to the downtrend line and some, I guess, the end of the volume distribution. So we have to be a little bit careful with this earnings range. If you start getting below these 49s, I would really use the 50 MA. If you start getting below the 50, it really shouldn't be. It shouldn't be. You can see, look here. This was resistance here. This should really be support again. So maybe there is a little bit of profit taking here just because it ran up so much. But, it's an expensive stock, but I believe they're going to grow into their multiple. I've told some stories about this that I'm a bit of a fan. Anyhow, we're well over, we're almost an hour in here. So let's call it a day. Anyhow, if you're not following me, my handle is @JustinPulitzer. Be sure to follow me on Twitter. If you like this video, just hit the subscribe button and the like button below. You'll get notifications about future weekend updates, Periscope rebroadcasts, and also special edition videos. So let's have a good trading week, and cheers.